Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mate.
Welcome to another episode of Equity Mates, a podcast where we will help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
I can't complain. We are all the way into March. The year is flying by. And as a result, it's that time of year where we've actually delayed this by a couple of episodes, but we are doing our Ask Us Anything for the month of February. And we have a huge list of questions to get through.
Yeah, we're gonna have to figure out a way to condense these questions because this is gonna if we answer them all, it's gonna be a very long episode.
Completely agree. We need to get some whizzes with the computer to come in and get our website so that we can start voting on questions. So, as you said, Ren, we need a way to be able to start vetting, because each month that goes by, we get double the amount of questions than the month before. So by December this year, we just won't be able to be answering everyone's questions. So if anyone out there wants to give us a hand with the website, you know our email, contact@equitymates.com.
Yeah.
Okay, Ren, so should we get stuck straight into it?
I'll ask the first question. All right, first question for you, Bryce, comes in from Brad. He is interested in lithium. He bought a lithium company 2 years ago, and he thought prospects look good, everything seemed fine, stock doubled in price, and 2 years later, now the stock is barely worth anything, despite having what he sees as good results. So he wants to know what's happened to the lithium markets and this company in particular. The company is AVZ.
AVZ, yes.
Yeah.
So, bought into it. Look, there's a number of things, I guess, from my point of view. Firstly, you investor sentiment, something that you can't control. But with a lot of these mining companies, the thing to note with AVZ in particular is that they are not producing any lithium at the moment. So they're in the exploration and discovery mode. And as Brad points out, they have had some positive drill results, but they are yet to translate those drilling exploration work into the actual production of lithium. And Ren, as we did in our summer series, it's critically important that companies start actually making some money and revenue. Another thing to note is that the price of lithium itself has been falling since January 2018. So as the price of lithium falls, then the value of the drills that the company AVZ has becomes a bit less in terms of what they can sell it for once they do go into production. So that might be a contributor to the price fall of the stock. And also that they did a placement to raise $9.8 million to continue, I guess, surging towards producing. And that $9.8 million, or essentially the raising of almost $10 million, was done at 3.8 cents per share. So that was the valuation done at the time. So you can imagine that if they do a placement at 3.8 cents per share, and it was trading at around 20, you would expect that it would probably come down a bit closer to what the placement was done at. So there's probably three reasons, in my opinion, why the stock is where it is at the moment.
Yeah, nice one. I left this question for you, so I've got nothing to add.
Okay. Well, do you want me to ask you one, Ren?
Yeah, go for it.
Okay, so this comes through from Rudolfo, and he asks, A2 Milk or Bellamy's, and why?
Well, I mean, if you're asking me, I'm probably very biased. A2 until I die, I guess. Look, I think A2 is going from strength to strength. The most recent half-year report had a 55% increase in profits. Bellamy's is going through a bit of a tough patch. In their most recent report, the recent half-year report, they had a 26% decline in profit. So, sort of very different stories at the moment. In saying that, though, potentially A2 Milk is overpriced because it's going so well, and Bellamy's is a little bit out of favour, and so the price that you're paying might actually be better. I haven't done a deep dive into the valuations and all of that, but if you were just looking at their recent fortunes, I think A2 is probably it's going from strength to strength at the moment. So I'm gonna keep holding.
Nice. I would agree.
All right, Bryce, next question for you. It seems like you're going to get the hard ones today, which is great for me. So this question is about a company called The BetMakers, which is currently undergoing a reverse takeover by PlayUp. I actually haven't heard of either of these companies, so I'm glad you're answering this question. So the question wants to know what happens when a company undergoes a reverse takeover, and if you're a shareholder in the company, do you hang on to those shares?
Okay, great question. So a reverse takeover or a reverse merger takeover is essentially the opposite of an IPO or initial public offering. And that's where there is an acquisition of a public company by a private company so that the private company generally can bypass the lengthy and complex process of going public. And in this situation, there's a lot of reorganization that needs to be done, as you can imagine, and there is a transfer of shares by the private company. So yes, if you're a public shareholder, then you will get a transfer of shares into the private company in which you can then do what you want. That's generally speaking, but there are a number of sort of different circumstances depending on which country you're in and a whole bunch of other reasons to do with the exchange that the company would be trading on. That it's not always the case, but generally speaking, yes, there will be a transfer of ownership into or out of the private company. So, Ren, your question. This question comes in from Tim, and he wants to know our opinion on the paid subscription stock picking services. There's a lot out there that are giving claims of strong growth, and he wants to know why not just follow what they do and then make the odd pick yourself.
Yeah, so I think as a general rule, you've got to be wary about anything that guarantees you results. Nothing's guaranteed in investing. So if someone's guaranteeing you 18% a year, I would be very, very wary. In saying that, I reckon there might be some value in the process. So if you're paying and you're getting lessons on, what their method is for picking stocks, how they value companies, or, what they're looking for in terms of momentum, and you're using it as a learning exercise to see how their process works, see when it does work, when it doesn't work, what are the determining factors for successful trades, assessing the results, all of that. There's probably some merit to that, but if you're going in there just blindly following their picks, I would definitely hazard against that. Nothing's guaranteed in investing, and anyone who says they can get you 18% a year consistently guaranteed, if they actually could do that, they would be working at the biggest hedge funds or endowments in the world, because everyone would love an 18% guaranteed return. So yeah, I'd be wary. If it's a learning experience, that's all right. It's just if you're willing to spend for that learning experience. But there's definitely some really interesting and good subscription services out there, but they're not the ones that are guaranteeing you a return every year.
Agreed.
All right, let's rip through this because I'm very conscious that we are going to have a long episode. We might even break this into 2 episodes and release them both today to sort of break it up a bit.
Sure.
All right, next one for you, Bryce. If you buy over a long period at a bunch of different intervals and the share price is different at each time, how do you then assess that for a capital gains, capital loss, tax perspective?
It's a really good question. And digging deeper, I thought there would be a bit of a complex answer behind this one, but the ATO, I think, do everything they can to allow it to be as easy as possible, because it could be quite confusing if you've bought a lot of stocks. So yeah, if I've bought 1,000 units of BHP at one price, and then 1,000 units at another price, and then 1,000 at another price. When I go to sell, how do I know if it's a price, if it's a capital gain or capital loss? Well, firstly, there's an accounting method called first in, first out, which you could use, if you sold 1,000 units, you would then say, okay, I'm going to be selling the first 1,000 that I ever bought, and then you can determine if that's at a capital loss or a capital gain, depending on the price at which you're selling. However, the ATO say that when disposing of only part of investment in shares, you need to be able to identify which ones you've disposed of. As shares are bought at different times, they may have different cost bases, as we know, and this will affect your capital gain or loss. And so it's very straightforward. You can determine and say which units you want to sell. The main thing you need to be aware of is that you need to be able to have records to prove which ones you're disposing of and at which price you bought them, so that you can have a clear record of that transaction. This is made easier these days, obviously, with online brokers, that all your transactions are in there. So you just need to be wary that if they ask, you need to prove that that's how many you bought and at which price. If you go to the ATO website, there's a whole bunch of information there. So I would suggest doing that, and also speak to a tax accountant as well if you want some more information on that.
Yeah, I think a lot of brokerages will help you with that as well these days, won't they?
Yeah, it's often a value add that they add on these days. Help streamlining the tax process. Yes.
Yeah.
All right, Ren. So
Hold
let's
on.
move on.
I think we should say, and this should be a caveat for everything, but this is not financial advice. Speak to a tax professional.
Absolutely. All right, Ren. So we've got another question here about ETFs, very popular. One in particular is SQQQ, which is a leveraged index, which I actually invested in. And that's a 6-part question, so a big one for you this morning. They also want to know about ETFs and decay, which I'm sure you'll get into. And let's just start with that.
Yeah. Okay. All right. So, that was a tough one to ask. I think there's probably a few things to split out. So I'll go from the general to the specific. So ETF decay is a term that some people might be familiar with. A lot of people probably aren't. It's a feature of leveraged ETFs, and without getting into the maths, it basically can result. How do I describe it? So without getting into the maths, probably the easiest takeaway is that most of the time a leveraged ETF will actually do worse than the underlying asset leveraged by the same factor. So essentially, if you're investing in this case an ETF with leverage, you might actually get worse results than if you had invested in the underlying asset with the same amount of leverage. Maybe I can explain it with an example. So if you have $10 invested, on day one it goes up 25%, and on day two it goes down 20%. That $10 went up to $12.50 and then back down to $10. So $2.50 up on day one, $2.50 down on day two. If you had invested in that through a leveraged ETF, when it went up 25% on day one, you'd expect it to go up 50%. And on day two, when it went down 20%, you would expect it to go down 40%. So putting real numbers to that, that means your $10 turns into $15 on day one, but then you actually lose $6 on day two because it's down 40%. So that essentially that's ETF decay. It means that you actually sometimes lose money when it's trying to track the index. So what we'll do is we'll include an article or something about it in show notes. So if you are interested in it, jump onto the show notes and read about it. But essentially, ETF decay is a risk of using leveraged ETFs, and it is something you should be wary of. And that probably leads into the second part of the question, which is, should you be holding leveraged ETFs for the long term? General answer is no. They're not designed for that. If you choose to do that, that's a choice that you can make, but just be aware of some of the risks and some of the problems with them as a financial product. And if you were going to do it, what I'd do is have a very small portion of your portfolio in something leveraged just because the risk is higher. So yeah, jump on the show notes if you want to learn more about ETF decay and some of the reasons for it, because I'm not sure I explained it that well. But it's an important term. It's good to understand.
Yeah.
In terms of SQQQ specifically, be aware that it's intended to inversely track the daily performance of the NASDAQ. It's not intended to perfectly track it long term. So there will be some divergence over the long term. So just be wary of, especially with leverage products, how the ETF is built, because that will have an influence on the performance. But it's a really good question. It's probably not something that a lot of listeners need to worry about. But if you are trying to get into products that are leveraged, that increases the return possibility, but it also increases the risk. So it's probably not something most people should or need to worry about. But if you choose to get into it, it's definitely worth understanding what you're getting into. And we'll include a link in show notes that will help explain it.
Nice one, Ren. Well explained.
Well, I'm not. Let's go with adequately. All right. Hopefully the next one won't be as complicated, but I've got to say I do like the fact that these questions like that are coming in. Like, I hope, if it's a term that no one has heard of before and people start to think about it, then like this Ask Us Anything has done its job. It's introducing people to new concepts. So
yeah, absolutely.
It's good. Keep those questions coming in.
Absolutely.
All right, next one for you, a little bit more straightforward. So Dean wants to know about our thoughts on Raise, which was previously Acorns. I know you're a user, so do you want to share your thoughts?
Yep. So Raise is a micro investing app for anyone who isn't aware of it. It takes your change when you tap your card. Say if you buy a coffee for $3.50, it'll take the 50 cents, round it up to $4 and invest that 50 cents into a few portfolios that you can choose. Firstly, we have interviewed George Lucas, the CEO, twice now. So check out episodes number 21 and number 61. They recently went through an IPO, so that was an interesting process that we spoke to him about. So for more information on Raise, go and listen to those. But you are right, Ren. I do use the app. I think it's a good way just to have another little savings account going on. They do charge, I think it was $1.50 a month for fees. Now, if you're only investing your spare change and paying $1.50 a month, then as a percentage, you're actually paying quite high brokerage. So I think my caveat with Raise is always you need to be putting your own money into it above and beyond the few cents that are invested through your spare change to avoid paying large brokerage fees, and also just to speed up the compound process. So you can set from anywhere between sort of $5 onwards per week or fortnight, whatever it may be, and it would drag it out of your account and invest it in large sort of index funds. So I think it's a great starting point and tool for early beginner investors just to have a play around and understand how these things can work. But I have it as a supplementary sort of fun thing on the side. It's never really factors into my investing equation, to be honest. So yeah, go and check out episodes 21 and 61 for some more information on that. But nothing against it.
Yeah, nice one. Now, given that we're brushing up on 20 minutes, I reckon let's finish this episode here.
Yeah.
And we'll do a second episode. Ideally, we'll release it in the same day, maybe the day after.
Yeah.
Just because otherwise, I reckon this episode might get to an hour if we just keep pushing through.
Okay, sounds good, Ren. Well, let's chat next episode.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.